This video is about harvesting static risk premiums. So I therefore first summarize some results from investing in US equity. Over the past 2 centuries, the average geometric annual excess return of US stocks over long-term government bonds was between 3% and 5%. The average excess return of long-term government bonds over short-term government bonds was roughly 1%. Now, the average arithmetic return is roughly 2% higher than the average geometric mean return. In a research study by Dimson, Marsh, and Staunton in 2010, the authors compare the equity market performance across 19 countries. Now, they argue that for the period 1900 to 2009, the equity risk premium in excess of cash was 5.2%, while the equity risk premium in excess of bonds was 4.2%, both for the US. And the respective numbers for the rest of the 18 countries was 4% and 3.8%. Everything denominated in terms of dollars. Now notice, the expected risk premium differs from the average realized excess return. Studies show that the latter is a very poor predictor of the former. This happens because, on the one hand, expected returns are time varying, and on the other hand, realized excess returns are strongly affected by unexpected price movements. Now, let's look cross-sectionally. Now, cross-sectionally, the CAPM in its plain form fails to explain why low beta stocks outperformed high beta stocks. And that gave rise to the by now well-known notion of betting against beta. Empirical results in the 2012 RFS publication of Bus and Wilkoff argues that historical data produces inaccurate estimates for forward-looking betas. When using option data to extract CAPM betas, the authors find a positive relationship between average excess returns and the beta. Now, more recent research also finds that using high-frequency data to calculate CAPM betas leads to a positive security market line and drives out the significance of Farmer-French's value and size factor. So for more on that, you could read the 2019 forthcoming management science publication of Holstein, Prokopczyk, and Simon. Now, one can also use valuation models to back out the equity risk premium. The simplest model is the Gordon growth model. Now, that is a dividend discount model with a constant dividend growth rate and a constant discount rate. The Gordon model implies that the expected equity risk premium of a firm I equals the current dividend yield plus expected dividend growth, as denoted in the equation here. So if asset I has currently a dividend yield of 5% and an expected dividend growth rate of 2%, the model implied expected equity risk premium would be 7%. Now let's turn to the static risk premium in government bond markets. The bond risk premium in the government bond market is also called term premium. It quantifies the additional return that long duration bonds pay over short-term bonds. The slope of the yield curve is a noisy signal of the bond premium. That is because the slope consists of 2 components. First, the change in the expected path of future short-term interest rates. And second, the actual bond premium. Notice both channels induce offsetting investment implications. It's hence important to tell these components apart. The usual approach to separate both parts is via an arbitrage-free term structure model. A recent model that also accounts for the term structure of the equity risk premium as a function of the economy is my work with Stefan Florich and Sven Schirmer, and the paper is called A Macrofinance Term Structure Model for Bond and Dividend Discount Rates. Now let's move towards the static risk premium in the credit market. Now, a research study by Dimson, Marsh and Staunton in 2002 uses data from 1900 to 2000. And the authors find that investment-grade defaultable bonds have only marginally outperformed US government bonds. The margin has been roughly 0.2 to 0.5% per year. Now, in general, the spread between yields of defaultable and non-defaultable bonds compensates the investor for the expected loss due to default or downgrade and for a credit risk premium. Some investors question the benefit of adding corporate bonds to a strategic asset allocation, while others emphasize the relative benefits for especially tactical asset allocation applications. So a tactical asset allocator would place bets on the expected change in credit spreads.
Got feedback? We would love to hear it. Please drop us a line. And if you liked the video, give it a thumbs up. And don't forget to subscribe to the channel.